Doing gets it done. Brought to you by Wells Fargo Bank, the bank of doing.
I've been on my own for the last 10 years or so. And for me, I thought this is like what being a successful adult is. But my wife and I, we started our marriage with $105,000 of student debt. We couldn't afford a house. We couldn't afford childcare. It kind of felt like you either get one or the other. But then my dad actually proposed. We all tried living together. We started our marriage essentially with $105,000 of student debt. And up until that point, I personally would say didn't have a good money management skills. What we wanted to do as soon as possible was to pay down the debt. But at the same time, like being a young couple, we were also wanting to have children.
Tay and Monica found themselves at the crossroads experienced by a lot of new millennial parents.
You can have the baby, and then you can have, the very expensive childcare, or we can try to pay down this student debt. Our other option is that one of us would have to quit our jobs and then postpone our debt pay down.
Homeownership, another goal of the soon-to-be growing Kim family, seemed entirely out of reach.
Home ownership, that's the symbol of the American dream.
That was 10 years ago. Today, they have 2 children, careers they are both committed to. They own a comfortable, accommodating home. Oh, and what about that debt?
We were able to pay off our student loans of $105,000 in 3.5 years.
So, how'd they do it?
I'm a 40-year-old guy living with my mom. So the initial idea actually came from my dad. When my dad proposed the idea, my initial reaction was like, there's no way, there's no way. I didn't think it was the greatest idea, but it was a workable idea.
What made the idea a little bit sweeter was that his father said that Tay and Monica could take ownership of the house.
My parents had already put the down payment for this home, but the cost of maintaining the house was expensive for them. So he said, you guys can have the house, just we get to come with the house forever, in perpetuity. To afford a home like this, I think would have taken us at least a decade or more.
Combining households, while complicated, has an obvious benefit. You have one shared set of costs instead of 2. One insurance bill, one phone bill, one utility bill, and everyone contributes to groceries. And one of the biggest benefits was that Grandma watched the kids while Tay and Monica both worked.
We were able to grow our careers, and that enabled us to maintain our income and then pay off our debt.
Back in college, like many students, we were approached with credit card applications. Many of us thought it was free money. Many of us took advantage of that free money until we learned there was an obligation that came along with it. And that obligation, fortunately, ultimately got satisfied. But it was a lot of hard work, a lot of stress, and probably some unnecessary stress as a result of not understanding the gravity and the severity of debt in inappropriate levels. Well, debt management is either the reduction or the elimination of debt. Well, first we have to accumulate debt. And if we accumulate that debt, now how do we deal with managing that debt? For many folks, it's a postponement, it's paying the minimum payment. And in paying those minimum payments, one may take a lifetime before they can dig out of that obligation. And so the reduction and the elimination sometimes has to be developed systematically. It has to be developed proactively. And being able to understand how to abbreviate and bring that debt under control and shorten the time horizon. Because money spent on the interest, not just the principal, is what can erode our ability to create the wealth that we might need for our future. The difference between good debt and bad debt is going to be the use of the funds. Are we borrowing that money for something that could potentially increase in value for us, or are we borrowing it for consumption solely? And it's the consumption side that worries me, and it's the consumption side that should worry the borrower. Because in that consumption, we are actually consuming tomorrow's money for today's use. But if we're using that money potentially to build assets and to build value. Now that debt could be good. Depends on what volume or what ratio relative to our assets. It could depend on what the rate or cost of the money might be to borrow that money. But if we can create and deploy money, other people's money through debt for the accumulation of assets, that can be a powerful use of debt. That could be a good use of debt. The bad use is when we use it for consumption solely. An example of good debt might be the purchase of a home and the mortgage that we take out in order to purchase that home. Here we're acquiring an asset that hopefully will grow in value. And historically, homes have grown in value. They're long-term assets, and if we utilize long-term debt, it's consistent, and we can pay off that home hopefully over the time horizon in a very functional, programmatic way, leaving ourselves with a high-value asset and a home that we can call our own. That's financially prudent and it's psychologically comforting. An example of bad debt might be the use of credit cards. Could be for multiple things. Could be for the consumption of goods that might not be necessary. Could be less than durable goods. Could be clothing. It could be consumption of alcohol beverages. It could be consumption of entertainment. And yet we feel like we're enjoying the moment, but we might be robbing tomorrow's opportunities by using the funds that we otherwise could deploy for accumulation.
The way we budget is first by knowing what's reasonable for certain amounts of money to be devoted to certain expenditures in our lives. So for your housing, you don't want to spend any more than 35%. For transportation, no more than 12.5%. If you've got debt that you're working on repaying, like student loan debt and credit card debt, that gets another 12.5%. 25% goes to your overall cost of living, and then 15% is the money that I want you to try to save. And I know that that sounds like a lot of money and you're probably not there yet, but you want to try really hard to work your way up to that level, because that's your money for emergencies. That's your money for your future. If you need to borrow from any category for any other, if you're not spending the full 35% on housing and you want to spend a little bit more on general living, totally fine. But savings is sacrosanct. You don't want to see that money going down. I want you tracking your spending. You can use an app to do this. You can use pencil and paper to do this. Your bank may have tools that help you do this, but basically you want to follow the flows of your money so that you know where your money is going down to the dollar.
To create a realistic budget, oftentimes it's not about trying to understand how do I curb each expense. It's making sure that you save first and spend what's left over. There's an old saying, too much month at the end of the money. And when we get to a place where there's too much month at the end of the money, we have inverted the relationship with treating money respectfully. So one of the things that we try to guide clients, and I think advisors should guide clients through, is saving first and spending the rest. So if a household could determine that they can save 10% or 15% or something thereabouts as the first thing they do, and then spend the rest, then the budget takes care of itself. It doesn't require meticulous caretaking as to how much pennies do I pinch in each category. It's what can I save first, put that away, and allow the rest to be spent. So debt consolidation can take on two different aspects. Oftentimes there's debt consolidators that will help you remediate and negotiate reductions of the principal balances, reduced interest rates, and give a programmatic way to pay your way out. That is one way of debt consolidation. It's kind of an imposition a third party takes on your behalf and negotiates a different solution set. Oftentimes we don't end up with the same credit score, same credit profile, because we actually have injured that profile with that kind of debt consolidation. But if the consumer is trying to be proactive and on their own and consolidate their debt so that they can underwrite that debt at a lower interest rate, oftentimes you'll see a home equity loan. If they have available equity in their home, they'll switch from a consumer-based debt of a credit card and they'll move that over to a home equity line of credit. That home equity line of credit could be 1/3 the cost of what that rate is on that credit card. It may also give them a longer period of time to pay that back. I wouldn't want our viewers to think that having a long period of time gives them a get-out-of-jail-free card to spend the rest of the money on other things, because that's only postponing the problem anyhow, maybe at less cost, but it's postponing that problem either way. So let's not obligate our home to an expense that we unnecessarily built on the credit card. Let's make sure if we put it on that home that we're dealing with that appropriately so that that equity in that home stays stable and we reduce that debt appropriately so that we're free from that debt obligation when the time comes. The warning signs that you overextended yourself is probably when the bills are behind. That's going to be a first one, or you're struggling to meet those bills. Any bills, whether it's the debt obligation bills or it's the bills of putting enough food on the table. All of those. And when we're facing that, the next DEFCON level is when we're not paying those bills and the creditors start calling. That warning sign is pretty serious. The gravity of that stress, mental, emotional stress, many times we try to hide from it, but unless we address it, it's not going away. The household that's struggling to meet their bills may have to take on a more aggressive posture. They may have to lean on that third-party debt consolidation firm in order to manage their way out of the debt. Because not sending our children to school, not putting food on the table, they're not options. Dealing with addressing this debt in an aggressive manner might be the option that can help that household bail themselves out. But I would caution our viewers that if we do it once, let it never happen again. Because that is not a solution. That's a pattern of what potentially can be very corrosive to the ultimate financial stability of a household. And let's face it, I'm no psychologist, but children growing up in a stressful financial environment, usually are growing up in a stressful emotional environment. And it doesn't feel good to grow up in that environment. I would recommend to viewers to stay mindful of the relationship of how much debt they have to their cash flow. Can I afford it neatly and smoothly within the cash flow that's coming in the household? The second thing is I would try to understand very clearly how much debt I have relative to how much assets I've built. Is there a healthy relationship? I don't know that there's a rule of thumb that it's $1 of debt for every $5 of assets. There probably is a rule of thumb that you could apply, but it's certainly not having $2 of debt for every dollar of asset. That equation is inverted and it's going in the wrong direction. It'd be very difficult to sustain it long term.
I'm Roman Collins. I was born in Louisiana, but I grew up in LA. And I am a worship leader, I'm a vocal contractor, I'm a musician, I'm a full-time student. My music is very inspirational, whether it's me doing gospel, whether it's me doing jazz or something fun, or whether it's R&B. I'm a firm believer of if it doesn't have a message, what's the point of giving it to someone? My faith is who I am. The thing that scares me about credit cards is the stress that comes along with it. I have thought about getting a credit card, but I wasn't aware of the benefits of it. I didn't see it as a necessity at that moment, but as I'm approaching 21, I do need to own up to it. So I just want to learn the do's and the don'ts of a credit card so I won't reinvent the wheel of suffering, of misery, of barely getting by. I don't want to barely get by. I want to be successful, but I'm scared because where do I start? What advice do you have for a 20-year-old who wants to start building their credit?
Hey Roman, I'm Jean Chatzky. I'm a financial expert and the CEO of hermoney.com. And I got into credit card trouble early in my life, so I know what it's like to be wary of credit cards. Here's the thing. building good credit and having good credit is important for adult life because it's very hard to make big purchases like cars or homes without having good credit. I would encourage you, particularly as you come out of college, to apply for a credit card. You can apply for a student credit card, which is basically a starter credit card, or a secured credit card, which is a credit card that you get by making a small deposit with the bank that issues you the credit card. But then the more important thing is that you use that card wisely. If you want to put training wheels on yourself and make sure that you don't get in over your head, you want to keep your credit limit small. You can say, I'm fine with a $500 credit limit. I'm fine with a $1,000 credit limit. I don't need more credit right now. And that's a perfectly okay thing to do. You can also decide that you're only going to use that card selectively. One of the easiest and best ways to build a pristine credit record is to just pick one bill that's the same every single month. So your credit card gets used, you pay it on time, you're never late, and you never get in over your head. I know you are looking toward a future where you're not struggling, where you're able to be successful and to feel like you've got a handle on your personal finances. Keep in mind, a credit card is just a tool that, if used responsibly, can help you do all of those things.
I've been banking clients for 30 years, and I'm telling you, most of them don't want to owe any money. They would prefer not to have debt. But sometimes debt is part of your growth, financing the growth, providing the working capital you need, to grow your business. And so an adequate level of debt is what's really necessary. And so teaching that to clients, having them understand that, debt isn't the enemy. It's just how you manage that debt and how you make it comfortable so that you can actually make your payments and you don't feel so pressured, and then you're growing your business. The aversion to debt in our community, I think, is deeply rooted in just your upbringing. We were always told that, owing money was a bad thing. Our abuelas and our ancestors always said, you sleep better at night if you don't owe money to anybody. And also where you came from, right? I came from Mexico, where interest rates were 20% or 18%, right? So the interest rates never helped you get out of debt, right? Because you were just trying to keep up with the interest, paying down the interest. And so I think a lot of folks are just reticent to, having a lot of debt because they don't want to feel the pressure of not being able to make a payment, right? Like something goes wrong or they have a hiccup in their business, and what if they can't make the payment to the bank? And again, those trust issues that are also deeply rooted, right, with large organizations. And, that combination is what I think causes that aversion. A healthy level of debt is one which provides you the flexibility that you need, allows you to grow, but also, that you can sleep at night knowing that you have the payment handled every night comfortably. So over 65% of your credit score is made up of really two things: how much credit you have, right, and how much you owe, and how are you paying it, right? 65% of the credit score is that. How much credit do you have out there that's open? And then how have you been paying against it? If you pay like clockwork, right, that is going to improve your credit score. The fact that you have debt and you have managed it responsibly is going to improve that credit score. And again, that's the biggest chunk. There's other things that go into the calculation, like what types of credit do you have? Is it a car loan? Is it a house loan? Is it, a combination of things? How many inquiries you make, right, to your credit score? Like if you're applying for credit every single week, not a good idea, because 10% of your score is impacted by how many inquiries you have. And so all that combination of factors is just to say, how do you manage your obligations, right? That's ultimately your credit picture. of what score you have. And credit scores matter because a lot of the banking organizations, we look at that score as a basis of making a credit decision, right? Are you credit worthy? And that score tells us, oh, this person's been making their payments on time for 30 years. They have impeccable credit. They never had a ding. They were never late on their payments. You're going to get the best deal out there, right? The best credit card rate, the best car loan, the best house loan, when your credit is deemed, really good and strong. Conversely, right? If you've spent some time getting into debt, you owe $9,000 out of the $10,000 on your credit card and you never pay it down. You only make, interest payments. That's not going to look good on you, right? And over time, if you miss payments or you missed your mortgage or during COVID, you couldn't keep up with your credit card payments, all of that is going to impact your score negatively. And ultimately, you won't be able to get the best loans for yourself at the best possible rates. Yes, I always do tell people they should know what their credit score is. And actually, most of the bureaus, if you just sign up to get the credit score, they won't ding your credit. It's just it's your information. You own it. They will show you what those credit, and there's 3 different ones that you can pull up and so on and so forth. But the fact that you pull it for your own personal knowledge is not a ding on your credit. And so you should always know before you do any kind of financial transaction, a home loan, a car loan, a credit card, even a department store card, whatever it is, you should know what credit score is going into that, because that's what they'll base their response on. And if you have a good, solid credit score, they'll probably give you a higher level of credit at a better rate. It all impacts the ultimate deal that you get. And so I would say go in eyes wide open, know what your score is. And if it's not ideal, there's ways that you can actually work to repair your score. And the bureaus are very, very good at, helping with that. There's letters you can write if there was some, issues where you couldn't make a payment. There's many things you can do. Sometimes it's a mistake. Sometimes somebody reported you that you were late, but you paid it on time. And so you provide documentation, they'll take it off and adjust your score. And so definitely a proactive management of your personal credit score is top of my list in terms of, just understanding your own personal finances. The advice I would give people who are trying to repair their credit score is to make their payments on time. Don't take out more debt. Manage the debt that you have responsibly. And so take a look at how much debt you have out there. Try to figure out payment plans to bring down the level of debt. Also, increase your savings, right? Have money for a rainy day so that you're not in a position where you can't make a payment. If you can only live paycheck to paycheck and you make your payments based on that paycheck, otherwise you can't make your payment, you run the risk that if you fall ill or you have a situation where you have to interrupt your work, you don't have the money, right? 30 days, then you don't have the money to make those payments. And so I would say manage the amount of debt that's out there, make the payments, even if it's the minimum payment, make them religiously so you're getting for late payments, because that's the first thing that affects your score. And I would say also, minimize the accounts. A lot of people go crazy and open every department store card that they can, every credit card that they can, every piece of credit that they're eligible for. And to have that much revolving credit out there, even if you're not drawing it, it impacts how much credit is open in your name, impacts your score. So I would suggest that you take a look at how many cards do you have, how many do you really need, right? And then manage those payments so that you're bringing down the level of debt.
First, when it comes to paying off a credit card, the cheapest, fastest way to do it is to work from the highest interest rate on down. We call this the avalanche method. So line up all your credit cards, figure out which one has the highest interest rate. Throw all of your extra money to paying off that credit card while making minimum payments on all the other credit cards. And then when that first credit card with the highest interest rate is paid off, you just tuck that one in a drawer and you move on to the one with the next highest interest rate and the next highest interest rate. And all of a sudden, you've paid them all off. The trick to doing this is not accumulating more debt, not doing more spending than you have to while you're paying these cards off. And that means getting a grip on your emotional spending. I want you to start using the purchasing pause. The purchasing pause is basically putting a little distance between yourself and that purchase. Put it on hold for 24 hours before you pull the trigger. What this does is give your emotions a chance to level off. You can try incorporating another behavior there that might make you feel better instead. For me, exercise does the trick. When I'm feeling anxious, when I'm feeling overwhelmed, I put on my running shoes and I get outside. If you do these two things, the avalanche and the purchasing pause, you're never going to find yourself in this situation again.
What it takes in order for you to really improve your credit score and really become financially, stable is a lot of work. I mean, it's discipline in your payments, discipline in the amount of debt levels that you have, discipline in your purchases, how you spend your money, how you choose to spend your money. There's frivolous things we can spend our money on. There's more important things we can spend our money on. And just really having a balance. And I'm not saying don't ever go out and don't ever have a fun time, but it's all about, moderation and conservatism, really, when it comes to our finances, because then you can sleep better at night. You can qualify for the best credit. You feel good about your debt ratio to your income, right? So you don't feel like, you can't sleep at night because you have so many debts. And so it's all about managing it. There's I think, levels of healthy debt that you can carry over time that allow you to maybe make that stretch purchase, the house in the better neighborhood. And you do that and you discipline yourself, and then, all will be well.